Every single interaction is valuable. You don't know who you're going to meet. It's always just people. Information travel through people. So if you're good at dealing with people and you're fair, you're adding value to them, and again, you're being forthcoming, honest, and just really seeing how you could align values and how you could work together, I think magic happens.
Welcome to Deal Flow with me, Michael Pouliot, the go-to destination for private equity and real estate professionals, including institutional investors, sponsors, and market experts. Each week, I talk with industry insiders on everything real estate, capital, and prop tech. Welcome to Deal Flow, the go-to destination for high-level private equity and real estate professionals, including institutional investors and market experts. I talk with industry insiders a week on everything in real estate. And we have Anjou today. She's the CEO and founder of Beam Investment Group, private real estate investment firm located in Houston, specializing in the fast-growing Texas market. She started investing in residential real estate in 2009 and eventually transitioned to commercial real estate, has passively invested in almost 3,000 units, and is the general partner in 1,600 units in Texas, which is over 8 large apartment complexes, and in 4 locations, express car washes in Houston, with over $200 million of assets under management. Thank you so much for joining us. I'm excited about
Yes,
this
thank you
conversation.
for having me. I'm excited to chat with you as well.
Yeah, so I know I gave you a little bit of a bio there, but if you wouldn't mind in your own words, just telling people about you and your background and then what brought you to.
Yeah, so, typical corporate executive. I was a CFO, used to work in Manhattan as well, CFO controller from $20 million to $600 million of revenues, different industries from logistics to media, events, also did healthcare at one point. And as a mom of 3, I always felt that there was something more, right? I felt like I had the ceiling already. What else am I going to do after being a CFO? Either I kept moving to another company, right? Larger companies, or perhaps start my own. And so that's one of the reasons why I did take my executive MBA at NYU, was to eventually start my own firm. So we did move from New Jersey to Houston, Texas 4 years ago because we were tired of paying state income taxes, and also that was the impetus for us to get started with our own business. I figured, you know what, since I have the better skill sets of accounting, finance, business, I can at least find something. And within just a few short months, because we've already done residential real estate in the East Coast, we saw the potential here in Texas is definitely growing, right? All the demographics are correct. The business environment was better, taxes and all that. So we were able to start commercial real estate investing very soon since we moved.
So that's 2021 that this migration happened, right? That is quite a time, right? So we're in the middle of the pandemic at this point, and the commercial real estate market at this point in 2021 was pretty competitive. So maybe tell me a little bit about your start in 2021. It's a tough time to enter the market and probably a testament to your guys' ability to find deals and be able to execute on transactions in a pretty competitive market at a competitive time.
Yes. So August 2021 is when we moved. And this that fourth quarter, I was just settling the family, getting them back into school. January 2022, I remember writing on my journal, my goals, and I just knew I was going to start some type of business. And it wasn't until I would say March when I started attending real estate conferences. Because again, I was the new kid in the block. I didn't really know anyone except for my sister who was already here in Houston. And so I just started looking at what the environment was like. But on the commercial side, you're right. Market at that time was still a little heated. And people didn't really realize that until maybe third or fourth quarter of 2022. But back then it was still 2x in 5 years. Some of my friends, and then show me the deals that's gone full cycle right here in Texas, would have been 2.5x in 2 years, not even 3 to 5 years. So it was really heated. But again, I was coming in new. And so I started attending conferences. It was right here, Briar's Club, like a country club here in Houston, just a small event, maybe 75 people, but everyone was there, meaning lenders, brokers, operators, developers, investors. So I just went in and tried to listen to what's going on. And I realized earlier on that the darling of the commercial industry are two things: industrial and multifamily. And since I didn't really have background with industrial, I was just a single family residential type of investor. And we've held some smaller multifamilies back in New Jersey. I dove into multifamily. And at that time, yes, you're right. It was harder to raise capital even back then. I think by early 2022, there weren't a lot of deals. So I said, you know what, with my skill set, I could easily underwrite these deals, right? Or at least learn and be very proficient with it. But I figured, you know what? That's not what these people need, right? The operators, the future partners, that's not what they're looking for. They're not looking for someone to underwrite deals. They're looking for someone to help them fund the deals. Earlier on, I got better into raising capital because I said, if that's what they need, then at least I can start adding value, start partnering with them with these deals. So at least I'm not putting all the capital for a smaller project. Let's say I put 1 million on a like a 20 unit deal. I said I could still go big, buy something bigger, but then now I'm working with experienced partners.
So tell us then, maybe let's talk about the first. I know you had said you've already done single family previously. Maybe we'll touch on that if we have time, but let's skip past that. Let's talk about the first multifamily deal that you were involved. It
Sure.
sounds like you started to partner with other experienced operators and help them with the capital raising, investor relations, stuff like that. So maybe just walk us through that process and how you found the operator. How did you get involved in the project and how did it all work out for
Yes. So first year, I just gave myself, all right, 1 full year to do whatever it takes. I'm going to go to every conference I potentially could go to. I've joined some masterminds as well, but I was very active in our local meetups right here in Houston. And I would attend conferences wherever I could. So my first ever deal, I was actually recommended into the deal. Because remember, it's not what do you know, but who you know and who knows you. So for my first ever general partnership, I didn't even feel like I was ready. I don't even think I had business cards at that time. I just knew that it was a great opportunity. Just running my own numbers, right?
you?
That was around June of 2022. So again, I started around February, March, just attending conferences and learning it by myself and joining some masterminds. And by June of 2022, that's when this opportunity came knocking at my door. And same day, as soon as they talked to me, I drove to the site. That's what's helpful when I'm investing locally. I feel like I'm at least boots on the ground. I was able to see the location, and it's in Sugarland, Texas, which is a suburb of Houston, at least $100,000 average household income, 135-mile radius. So I knew already it was a great location. I had cousins who lived there, some family members who lived there. So it wasn't like somewhere where I would have any doubts as to the location. And now it's just a matter of the deal and, of course, the operator. So, as with any deals I've done, I've always checked the operators first. And so, what I did was I talked to a lot of those friends I've met along the way locally, and I've asked them, hey, have you heard of this group? And some of them had invested passively who are now operators. Some of them have also partnered with them as a general partner in other deals. And all the reviews I've gotten were they're amazing. They're very good in communications. They're very fair. They're just basically on top of their game. They're a class act was one of the things I heard from this couple was a lawyer and a doctor that was a general partner with them on the deal. Later on, I found out that my future partners were also passive investors in this deal. So it just gives me more of like I can sleep better at night, knowing that at least I did what I could for my first deal. There weren't a lot of deals. So you just gotta find out the best deals at that time.
And have you done multiple deals with this sponsor or is this
Not yet, because that was the last property they bought since
okay?
August 2022. So now I think they have a deal that they're looking at in Dallas. And so that's why I had to keep looking for partners that are actively buying in this space because since capital was constrained, some groups could only maybe purchase one or two a year versus maybe last year or the year before that, maybe they were purchasing double the amount. So I kept looking. And for me, it was always about the operators. Can I work with them long term? Because it's not one and done. I'm local here and I want to do this for the next 30, 40 years. So I'm looking for that partnership and also that volume. Who are the groups that are looking to expand in the future? But again, going back to your question on that first deal, it was rough. Like I did raise $1.3 million for the first deal from 8 people, myself included and my sister, and then the rest were out there, New Jersey, New York. Some of them are my friends, classmates from NYU. And it was just, you just got to do whatever it takes because that's the first deal. I knew it was going to be on my track record. So I had to perform, and I'm glad that I did.
Yeah. And could you tell me a little bit about the deal? Is it typical for the type of deals that you continue to do? I know the sponsor, it sounds was the most important for you, and that's the first thing you're looking at. But maybe talk a little bit about the types of deals that within multifamily, there's a wide variety of
Yes.
opportunities. Tell us a little about that first deal, similar to the types of deals that you're doing since then.
Yeah. So I've only done multifamily value add, right? That first one was built, I think, 2008. It was about 288 units. And so most of the acquisitions after that are roughly around the same size, 2 to 300 units, multifamily, and I've gone all through class A, class B, class C. The smallest I've purchased now with partners is 44 units because that was a seller financing opportunity, which we couldn't pass. I was like, that's perfect. Maybe sometime in the future, I'll buy it by myself and buy out my partners. And then before that, we had 128 units. That was a loan assumption, 82% fixed rate, Fannie Mae for 5 more years. So again, we're seeing these amazing deals. So I wasn't really particular on maybe 300 units, but rather who's the operator, what's the deal metrics like. And now I've started to vary the sizes as well, just because I know that later on, because remember, our goal is to double the money in about 5 years or so, maybe at this point, 6 years, depending on the market. I want to have multiple exit strategies even for my investors, right? So it's not all 2 to 300 units, which let's say is about $30 million, that I could have something within the 10 to $15 million range. So later on, if my group just want to buy it all by ourselves, we could as well.
And so you talked about the operator and the deal metrics. Maybe let's talk a little bit about that. So when you're evaluating an operator to work with, what are you looking for? What's red flags or green flags for investing with or establishing a new partnership with a new operator for you?
Yeah. So for me, basic ones would be one, that they're local, right? So not only are we investing, let's say in Sugarland, my general partner, the guy who signed on the loan, also lived in Sugarland. Right? Not that I have to be very particular that they live exactly in that town, but I want them to have local presence because I think it makes a difference. I've had other deals out of the eight. So moving forward, yes, absolutely. If they're really local with their teams, I think that's much better. I've worked with both vertically integrated teams and those that are, let's say, third party, especially for the smaller one, the 44 units, 128 units. We don't have our own property management firm. We're not vertical on that. So I've done both, and honestly, they're both working fine. So it's just a matter of who's the jockey, right? Who's doing the asset management calls? What is their core competency? Because I bring in that capital, I want to make sure I partner with someone who's very strong in operations. And this is not someone that's going to say, oh, I've done project management in my corporate job before. Most of my partners have already done operations either as a property manager or maybe as an asset manager for commercial deals, right? The other thing I look for in terms of green flag and red flag, easy green flag, and here's a tip, is if there's another operator who's not a general partner or key principal on the deal, right? Another operator or GP from another deal that's investing in that deal passively. That's a green flag because they know what they're doing. They're also local. So if they're investing, it just tells me that, hey, you know what? They're willing to park their retirement money, right? Because our IRAs, we can't self invest. So they invested with someone else. So they must be really good operators. So that's a green flag for me too. Some of the red flags I've seen, aside from, let's say, an operator that's not boots on the ground, I've seen some groups that are too big, right? There are way too many cooks in the kitchen. And so sometimes I have to really find out who is the main decision maker in this group. Is it just one person? Is it a partnership or is it like 3 to 4 people? I don't want it to be a democracy of every time you need to make a decision, there's got to be 4 or 5 people that has to sign off on that decision. So I look for that too. And again, because I'm here and Houston market is very hot, I've had a lot of people send me deals. I'm probably looking at 8 to 10, just even multifamily deals at any given time. And maybe I'll choose one or two that I would like to work on. And so some of the things I've seen is really track record. Sometimes people would say, hey, you know what? Yeah, we have 3 deals or 100, let's just say 1,000 units that's gone full cycle. And then when I look at where it's gone full cycle, it's not even in the area where we're buying. It's good to have deals that's gone full cycle, but we also have to keep in mind the timing, right? Because you're right. Maybe this was during 2020, 2021, and all the results were spectacular. And now they're branding themselves with an IRR of 20 to 30%, which we know is probably not going to repeat anytime soon. And also Houston, for example, even Dallas for that matter, is so big. Houston, just the metro, is bigger than Boston, New York City, and San Francisco combined. So when people say, oh, I'm investing in Houston, I really got to see where in Houston it is because I could drive 2 hours one way and it's still Houston.
Right. It's like
So
saying the
just
Northeast.
really,
I invest.
yeah, just fine tuning all of those details because the devil is in the details.
Mhm. Yeah, so that's some good stuff on operator. And then when you think about deal metrics, I know you talked about, yeah, 20, 30% IRRs, probably not something that's sustainable over the long term. It's more of a getting lucky on the timing, or maybe we'll get it every 20 years. We'll have a 3-year period where we can get that type of return. for our investors. But what are you seeing as you clear the operator, you clear the market, you feel good about those things. Now you're looking at the deal level. What are you looking for ultimately, or what are your investors looking for ultimately on the
Sure.
deal metric side?
Yeah, so right now, because I'm picky, right, with what deals, because I personally invest in these deals as well. So for the deals that I'm looking at, I still want a 2x in about 5 years. And granted, it's not going to be exactly 2x, but from what I'm seeing now, that's still possible depending on, of course, the location, right, the operator, like that assumption loan that we just did, right? 3.82% fixed rate Fannie Mae for 5 more years, and it's cash flowing. My other deal, which is in Tomball, so this one is 228 units. It's similar to the first deal that I did. So this one's more, well, let's say class A minus, right? 2006, 2007 built, very good location, about $100,000 average household income. This one, our delinquency for 228 units is less than $1,000. So essentially, it's almost like zero, right? Because we collected the following month. So I like those deals with good fundamentals. And that one we bought at a 6.5 cap rate, April of last year. So we're still seeing deals. And I still believe that these deals are going to go 2x in about 5 years, probably not 3 years. So now it's starting to look like 5 to 6 years. But I've also started looking into other asset classes because I realized that, you know what, at the end of the day, it's all about cycles. If multifamily right now is having this much of rent growth, which is not a lot, and you're banking on like maybe cheaper debt, then I'm always looking for what's the best and highest use of the capital. Now, that's why I started looking into car washes because with that, it's about 3x in 4 to 6 years. You're buying the business, it's cash flowing already, which again, in multifamily doesn't cash flow as much. You're banking on the equity. But on the car washes, we have more cash flow now because we're buying, at least for the ones that I participated in, these already have 3,500 subscribers. So I like deals where I could make sure that at the end of the day, my investors are getting a diverse portfolio where you have some cash flowing assets, true cash flowing assets, where you have some equity play, and then you still have depreciation for both.
Yeah, so tell us a little about car washes. I think that there are other folks that are out there who in a similar situation where they're like, hey, I'm here to provide value and opportunities for my investors, but maybe there is not a lot of opportunity right now or very selective opportunity in the very large multifamily space. Not a lot of transactions happening. And so if you want to still provide value to your investors and you want to show them something that has similar returns or better returns potentially, similar tax benefits, car washes tends to be one of those things that people can wrap their head around, right? If they're already a multifamily investor, it's okay. There's residents and now there's cars. And it's like there's some sort of PP&E on both sides. So you're always dealing with some sort of physical asset that you can depreciate. So maybe tell us a little bit about car washes and what makes them similar or different or interesting to investors. And what can you typically expect from just a P&L perspective? Just walk us through
Sure.
what that looks like.
Yeah. So one thing that's similar is that yes, you do get the cash flow. So it's still quarterly distribution, right? You have the monthly newsletter with all the results, the dashboard KPIs for the individual location. You still have the equity play, which is great. And then you still have depreciation because the equipment in itself is about $2 million and equipment gets depreciated in 5 years. So it is accelerated. It's not like 27 and a half on the
Mhm.
real estate side, a straight line. What's different is that really now, see, multifamily, you can't really roll up. I'll get into business roll ups, which I think is a very hot topic right now. And it's been there forever. It's just that most people don't place capital there because they don't know how to access it. So, yeah, most people on the real estate side or alternative investments, they'll get started with, oh, let me be a landlord, which is how you and I got started, landlord or maybe flipping houses. So, business roll ups is great because this is really how you add value to not just a single business, but the more that you buy of them, right? The more you buy and roll it all up, the bigger the equity multiple could be. So, for example, car washes right now are trading about 12 to 15x equity multiple, which again, in multifamily, you won't even hear numbers like that. But that's because in businesses, some businesses, it's not about the cap rate, it's about the EBITDA, which is your earnings before interest, taxes, depreciation, and amortization. So just think of it as really the earnings that you have for all the operations. And so what we're doing for the car wash, I'm not just buying three. The three that I bought is already part of 10. And our goal is to buy 7 0. But as with any new business venture, I always start with the operator. I came across this group because I was a passive investor in them 3 years ago for some of the multifamily. And these are local guys, they're here in Dallas. But our partner, who's the operating partner, has already bought or built and sold 65 car washes in his lifetime. Basically, he's done two big roll ups, bought and sold it first time, and then did that again for another brand. And now we're doing it third time. So those are the deals I like where I feel like I have at least some type of competitive advantage. It's definitely much better than all the multifamilies I've seen recently, even in our area here. And it's local. The car washes are in Dallas and Houston so far. But that's our goal is to expand it. We have 17 in the pipeline already because of relationships. We're getting our pricing wholesale. And at the end of the day, it's about creating a business model. And this one, again, is subscription based. So it's what we call express car washes, wherein you just drive through it, right? And the machines are washing your car. It's not like a person that's washing it. Then if you want to vacuum, but you do that yourself, right? On average, for these types of car washes, let's just say $20 is the minimum if they were going to go on a subscription. But on average, we're getting 65 to 70% of our revenues in day one, rain or shine, hurricane, tornado, it doesn't matter. So that's what private equity is gobbling up, right? They want subscription based, stable cash flow because they can forecast it. They don't want the ups and downs of seasonal businesses. They want something that would generate cash flow day in and day out.
Yeah. In Texas, you have the benefit of that. That's a 365 business, right? If you're in the Northeast, not many people are washing their car in the middle of the winter. It's a tougher slog for those
Yeah,
car washes out there. So you talked about roll ups. I assume that the ability to get the higher multiple on exit is part of your business strategy. So you're expecting, I would assume you're buying these car washes individually at a relatively low multiple and then putting them together and then hopefully selling the bigger portfolio to a private equity
correct.
firm ultimately as a package. And what are you seeing even individual sites sell at 12 to 15 times multiples?
Oh, no, absolutely not. The
Those are like,
15 is like what Quick
yeah,
Quack,
right.
Mr. Car Wash are. This is what private equity is already buying right now. We know that even for our underwriting, for example, with just what we already have, we only put 8x equity multiple, but we already know our competitors for the size that we want already selling for 12 to 15x. So again, it's a very different industry. I've had another friend who's a pharmacist and he was able to sell his business for about 8x, right? It's not like you get into the double digits unless you're a tech firm or you have some type of subscription model.
And your earnings have to be over a certain amount typically. Yeah.
Yes,
So that's great. The plan is to get to 70 locations, and that's through this operator, right? So they're the ones helping find, sourcing, compiling the portfolio, and then you're tacking on these new properties and then buying them individually and raising the capital for those as you go. What does the cash flow profile look? How does that different from apartments? So I'm sure it's not all about the upside, the sale at the end. Presumably, as an operating business, I would imagine there's more cash flow for this
hmm
type of business than there is for apartments, at least at the start. What does that look like?
yes, absolutely. Especially because the three that we're buying right now, they're all already operating. We have about 3,500 subscribers in each. So the cash flow, it's not like you get all of the, because in multifamily, it's more towards the back end. Maybe you get 3%, 4%, year one, year two, year three, four, five. If they do have a pref, maybe they start paying that 6, 7, 8%, depending on how much they've invested. And then all of a sudden you get this big check right at the end, which is your capital plus any gains. And cash flow is a little bit different. That's more smooth, right? Because the business already operating. And it's not going to be like that for everything because we do this as a fund, right? I've done 3 funds as well. So this one is on my car wash fund. And that's why I like that it's packaged because right there I have diversification with 3 locations, but really the value of the three is contingent upon the value of the other 60 something car washes. And we're not saying we're going to sell it all. If we have someone who wants to buy even half of that for way more than what we forecasted, depending on timing, yeah, we could sell it too. But that's the main difference between multifamily and car washes is that multifamily, it's all that big fat check is towards the end. So maybe for retirees, those investors that are really counting on a more consistent cash flow, maybe multifamily is not best for them at this moment, at least for the next few years. Whereas in car wash, because it's already existing car wash, and again, you have all those subscribers, you're able to rely more on a more consistent quarterly distribution that's easy 8 to 12% or more. As you go to year 3, 4, 5, it's going to be a lot more.
So as we're getting to the end here, I would love it if you could share with us, you've been able to do quite a bit here in the last 4 or 5 years between the multifamily, building this large portfolio, investing a lot of capital on behalf of investors, and then also building this car wash roll-up strategy. Could you give us, for someone who maybe is just starting out and trying to replicate your success or even just get a little bit of the same type of success, what would you give just some golden nuggets for listeners who maybe are wondering where to start or how to replicate what you've been able to do?
Yeah, I would say be uncomfortable. Nothing I've done to this day was comfortable. It was always like, even my first meetup, which was with that operating partner for the car wash, drove 4.5 hours to go to their meeting because I thought they were the only ones that was doing it. I didn't know anyone else at that time. And it was uncomfortable. I didn't have business cards. I didn't even know what multifamily investing was. I didn't know the lingo, GPLP, IRR. I didn't know anything about it, but I was willing to roll up my sleeves and learn. So if there's one thing I think I've excelled at is really just learning, soaking up what I could, because every single interaction is valuable. You don't know who you're going to meet. Like just before this, like earlier today, I was meeting with some groups in Qatar that are looking to invest in Houston. How did that come about? From another referral who was a friend of someone else. So it's always just people. Information travel through people. So if you're good at dealing with people and you're fair, you're adding value to them, and again, you're being forthcoming, honest, and just really seeing how you could align values and how you could work together, I think magic happens. And one of the things I've seen new people do is that they give up too soon, right? I've had people from 2022 when I started, now they're no longer buying multifamily, they're doing something else. And I'm like, you got to be committed. This real estate or even one asset class, you can't just do this for a year or two. Most of the cycles are 5+ years. So even if this was a big traditional small business, you would have to stick through it until it really profits. And I think if you quit so soon, then it's a waste of all the energy because you've been digging all along. You've been sowing these seeds. For you to really reap it, you got to stay long enough and see the harvest. And that's what I'm seeing now. Now I have more than 100 plus investors that's invested with me passively in these deals. And now referrals are coming in. So you got to be there though. You got to stay in it for the long course. Just really have that endurance and patience because
Yeah.
that's what's going to pay off.
That's great. Yeah. Thank you so much. That was a great tidbit. I think, yeah, making sure that you don't quit three feet from gold, as they say.
Yeah.
Anjou, thank you so much for your time and for sharing some great insights and knowledge within the real estate space and the car wash space. If
Mhm.
listeners wanted to get in touch or find out more about you, what would be the best way for them to do that?
Yes, you can connect with me at either Facebook or LinkedIn. My company name is Beam, BEAM Investment Group. You can go to my website, beaminvestmentgroup.com. And if you're ever in Houston, happy to help. Or anywhere in Texas, if you're looking at deals over here, you want a second opinion, happy to help as well.
Awesome. Thank you. And great for tuning into this episode of Deal Flow. Don't forget to give the podcast a follow on Apple Music and Spotify and subscribe on YouTube so you don't miss an episode. And of course, if you feel like someone else would get something out of the show, please go ahead and send it across to them. Feel free to comment below regards to future guests you'd like to see on the show or to get in touch should you think that your knowledge and expertise would make for a great episode. Thanks again for me, and I'll see you next time on Deal Flow.
Thank you for listening to Deal Flow with me, Michael Pouliot. We hope you gained valuable insights into private equity real estate and market trends. Stay tuned for more expert discussions and updates on the latest in commercial real estate and structured finance. Don't forget to subscribe, rate, and review on your favorite podcasting platform. Join us next time for more high-level conversations that empower your investment decisions and your operating results.